Welcome to the first in a new series of videos and podcasts where we'll be talking to leading institutional investors and asking them to explain the strategy of how they're looking to invest in the listed space. And I'm joined today by Friso Berghuis, who's Director of Listed Investment here at Bouwinvest. Friso, thanks very much for joining us. It would be good just to get from you a little information about yourself, the company, and also the strategy here at Bouwinvest.
Yeah, thank you, Richard, for having me. And I think it's good that I've been with the company for 13 years already, which sounds like a long time, but I'm enjoying the ride within Bouwinvest, which is an ever-evolving company. And within that company, we work with 200 investment professionals. We have 5 dedicated Dutch sector funds, and we also run 3 regional mandates. And Bouwinvest is deeply rooted into the institutional investor space with over 65 years of experience. And our goal is to strive for sustainable returns for our clients. And we do so by having predictable returns, and we do so via these 5 Dutch property sector funds and 3 regional mandates.
How does the listed side fit in with the overall strategy?
Actually, the listed investments, they represent around 25% of our global investments. And we identified the listed sector as interesting more than 10 years ago. And gradually this evolved into a fully integrated approach. And why did we integrate listed into the 3 regional mandates in Europe, Asia Pacific and North America? Is that first, from a strategic point of view, it's really important to realize that it's a mature part of our investment opportunity set. Secondly, from a tactical point of view, we leverage on the liquidity, so we can easily access certain niche markets or sectors, as well as rebalance and rotate within that regional mandates. And thirdly, operationally, we act on global listed real estate movements in the market.
What was the kind of key driver, particularly for investing specifically in listed real estate?
First and foremost, for us, listed real estate is real estate. And that was once again confirmed on the EPRA annual conference last year, as well as multiple papers published around that. And in addition, we see that when adjusting for the time lag and the volatility, you see that public and private real estate actually is the same. Last year we celebrated our 10-year anniversary of our fully integrated approach, but it is important to note that we increased our global investments following the GFC. In growing that portfolio, we identified multiple interesting sectors, niche sectors as well as markets that were tightly held by listed companies. In the exploration of optimizing our portfolios, we thought, well, if we want to have a truly global investment portfolios, it is key to include listed real estate as well.
And you mentioned there an integrated approach. So how did you then execute that in terms of the strategy?
In 2012, we were granted approval by our sponsor to invest via listed investments as well in the opportunity set. And at that time, we also explored how we should do that. And that made 2 decisions very important. The first decision, how we would make our own allocation investment into listed. And we decided to do that via a subset of listed companies. And the second one is to execute by teaming up with external investment managers with local presence.
What was the kind of key driver, particularly for investing specifically in listed real estate?
First of all, it was key to us to allocate ourselves to specific markets and sectors. And we only want to invest in the best quality companies within a sector or a market. And we also preferred and still prefer companies that maintain strong balance sheets and that avoid unnecessary opaque capital structures with poor governance. And lastly, ESG, it's very important to us, and we would like to invest either in companies that already meet our targets in terms of ESG, or at least have a clear pathway to get there. And then it brings me to the second one. Why did we decide to partner up or team up with external managers? First of all, as well as in direct real estate investments, local market expertise is key. We're based in Amsterdam. We have offices in Sydney and New York, but it is very important that we have local analysts from the external managers on the ground. So boots on the ground is very important to us. In addition to that, these external managers, which we selected via a very thorough process, they represent multiple investors. So if you only have a small piece of the pie in terms of a company's shares, they represent multiple shareholders. They have long-term engagement with these companies, and it is key to us that we can lever upon that as they represent more capital. Lastly, we would like to have flexibility within our listed investments, and via external managers teaming up with them, it allows for that, and we don't need the infrastructure required when you do the trading of shares ourselves.
How important is diversification for the strategy here?
Yeah, Richard, diversification to us is key. It's not only through markets and sectors, it's also via investment styles. We identify open-end funds, closed-end funds, joint ventures, club deals, and listed real estate investments are part of that. And listed real estate investments, they come with higher liquidity, higher transparency, but also on the other side of the coin, there's higher volatility and more limited influence. And incorporating listed investments into our opportunity set, it brings us exposure to niche sectors like self-storage, healthcare, data centers, but also on the tightly held markets I referred to earlier, like the Nordics, but also Canada, Hong Kong, Singapore. Secondly, you get the allocation towards high-quality portfolios and seasoned management teams. And the increased liquidity is due to the fact there's daily pricing, so we can act swiftly on market movements. And most importantly, perhaps to us, to our integrated approach, is that the listed markets give us directional information. So if we have the continuous collaboration with our regional mandate teams, also with the non-listed space, the listed markets are 9 to 18 months ahead of the direct markets. So we can have good discussions and enhance these by public market information. And lastly, there's the exploration of arbitrage. For instance, we did several top-up investments in Europe in Q4 in 2023. And the reason why is that we thought the markets, the listed markets, were undershooting at that time. So in discussions we had internally, we thought, well, this is the right time, the right moment to add via the listed space as opposed to the non-listed space where the valuations were higher back then.
And look out for the next in the series where we will be looking at another key institutional investor.